runs have happened since the 1920s, and we just have there's no solution for bank runs. If you lose confidence in the banking system and your bank, you take your money out. And it's easier these days to take money out than it used to. I mean, within a day, everyone can take their money out electronically. So you just have to. I think I think the Fed has to, and the people that make the rules for banking have to realize this is a different world than when they originally made their rules. So I guess these bailouts are preventing further cascading bank runs. And we're starting to see many bank runs even now. There's people taking their money out of the smaller banks and smaller companies. Okay.
But
right.
Also that's big bank nowadays actually after um, the revise of the requirement on balance requirements, they get stronger, right? So the generally going to be falling under is grab only for regional bank that actually succumb to the issues.
What's interesting, they're doing a lot of testifying, on Capitol Hill now about what's going on, what happened, how can we prevent it in the future. And they were grilling Janet Yellen. And basically what's happening right now is smaller banks, regional banks, they're called. They're not, the big ones like Bank of America, Wells Fargo, and JP Morgan. They're they're kind of struggling, and JP Morgan, the big banks are actually taking market share. They're getting bigger. Whenever there's bailouts like this, and there's got to be the big banks have a lot of liquidity. They have a lot of money available for situations like this. And there was the Dodd-Frank law that was passed that made sure that they were well capitalized and they followed certain rules. And so what's happening right now is the big banks are getting bigger, and that's against. I mean, Janet Yellen said there's nothing you can do about that. That's just what's happening now, and they're getting more critical, and they're becoming. The big banks can't fail now. So what we can, I'll show you a couple of slides later on about Bank of America. How the biggest problem right here we've been talking about for a year is no one knows. No one knows the ramifications of raising interest rates so fast in a short amount of time. And all the banks have been caught off guard because banks basically make money by they invest short term usually and lend long term, so that they'll give you a 20-year mortgage and then they'll get some money. They'll invest short term usually, but what the problem with these banks, they saw an unlimited amount of time, like 10 years of zero interest rates, so they had to put their money into something to generate some income. They bought long term securities like Silicon Valley Bank, and then it's called an unrealized loss. If you buy a bond, let's say that pays 3%, that's a 20-year bond or a 10-year bond, and they raise the interest rates 2%, that makes that bond worth less, par value. And that's basically what's happening in all these banking issues. There are companies like Charles Schwab that we've been following that company for several months now as a decent company that's it's a growth company, but they got caught into a situation where a certain amount of their deposits they put into long-term treasuries, so they have unrealized losses. If they held those treasuries to 10 years, then they'll get their money back. But the problem is, if there's a bank run, they're going to have to liquidate and realize a loss. And that's what all these banks, that's the majority of the problems in the banks and companies like Charles Schwab these days. So it's in Bank of America. I'll show you that screen because we're on the topic. Might as well talk about it. The Bank of America has 113 billion in unrealized losses. So it's only people that really understand these balance sheets of banks. They have to declare, their financial status. But 113, that is 60% of tangible book value. So if there was a run on Bank of America, they'd have to liquidate in order to generate cash. And they would have to realize a loss of $113 billion. That's just an example, some lesson, something that might happen. So if banks, but is there a solution for that? I think what's happening is the Fed is opening a window where banks can borrow money for these kind of situations. So I don't know. We don't know anything about banks, really. We don't. How are we going to understand that? It's just right now you got to stay away from that. You can't be like playing. You can't be like a hero. They say right now. No, you're not going to be able to time the bottom of this, and it's just we're concentrating on stocks for the most part that are pretty reliable and unaffected by things like this. All right. So what I did for March, we had two reports that came out. Basically said that inflation is still decreasing, but it's still a problem. That happened early Tuesday and Wednesday. Next Wednesday, we're going to have a statement from the Fed. I don't know why I didn't have it on here, but they're going to be talking. And so on the 22nd, if the Fed says something where, listen, there's problems out there, we're going to pause for a while. If that happens, the stock market's going to take off, but they haven't been saying anything close to that, so don't get your hopes up. But what's interesting that happened in the past week is the Fed introduced money into the system. So it was like quantitative easing in a way. There's 300 billion in liquidity added to the Fed added 300 billion. That's like reducing interest rates. Because that adds more money and that makes more inflation more of a problem. So it's getting weird. We don't understand ramifications of all that. It's just getting so weird that we have to be realizing that there could be a crash, and this financial thing is turning into a huge problem. All right, so what's happening today, the 17th, we have that marked since the beginning of the year. It's a triple witching day. So we have expiration of options. And so what that means is say if you say that you sold some puts and you got to cover them, or you bought some calls and you want to buy some stock because there's a lot of options that expired today. So that makes the stock market very volatile. And every Friday, traders like to get rid of things off of their books in case something happens over the weekend. So there's a normal selling that happens every Friday. All right, so but this normally is a great month, of the year, and we have end of quarter window dressing usually. That happens every 4 months. But in this situation, we have a crisis. So our focus is going to be on watching the stocks we're following and seeing if there's any babies thrown out with the bathwater during this crisis. Okay, so any questions about this? Any comments about what's going on? Any confusions? All right. So even with the ups and downs, all this craziness that's happened since last time we met. The S&P is basically a little bit unchanged. We had a rally earlier this week. Basically, whenever the Fed injected 300 billion into the system, that is a lot like saying we're done raising rates. We're starting to lower rates. So in the 2-year and the 10-year are down a lot. So down 7%, down 13% in 2 weeks. So that's a very good indication that the Fed is not going to raise rates as much. They might raise a little bit the next time they meet, but they're basically done. There was a rally in the stock market because there's a realization that we could be at the end of the tightening. So we've been saying since the beginning of the year, what worked last year will continue to work this year until the Fed is done tightening. So it might be towards the end of that right now. Because when the tightening's done and the Fed has, we're going to start providing liquidity for the market again because it's in turmoil. When that starts happening, then things probably will get back to normal. We'll stop going down. You see. Okay, so out here. Okay, so we're going to hope for dovish talk by the Fed next Wednesday. Dovish means they're going to help out the economy. They're going to reduce interest rates or they're going to stop raising them. And so that's going to help if that, and we have 2-year and 10-year going down. That helps the market out. You see. Okay, we're still oversold. We have fear in the market. So this banking crisis just throws all the stochastics, everything that we watch for timing, when to get in and out of stocks. It just doesn't work when there's a crisis. So in a crisis, we have to just look at fair values. Is this stock we're following affected by what's happening in the world? And we have to look out 10 years and say, well, is this going to be a stock that can withstand this? And do we get a bargain yet? A lot of the stocks we're following are still, over their fair value. So we don't have like super bargains yet. Okay. Any questions, comments about that? All right. So oil, good, I'm sorry.
You always say that Fed doesn't fight the rates. So with the rates coming down, how far is the Fed rate versus these 2 and 10-year Treasury rates?
Okay, let's look at another slide I prepared. It's a little bit down here. It'll be worth it. Okay, there's something called the Fed Fund Futures. You ever hear of that? They're basically,
yeah.
There's something that says what is that rate the Fed will raise until where it's going to stop. And so that before this crisis, it was at 6%. And now the Fed Fund Futures is at 5%. That's 1 whole percent less that they're going to raise. And at the end of the year, the Fed Fund Futures is at 4%, meaning the Fed is going to cut interest rates 1% before the end of the year. So there's a direct correlation. When we see these 2-year and 10-year go down 13% in 2 weeks, that is a direct correlation to this right here, the futures saying basically the Fed is going to be back down to 4% at the end of the year. So, sorry, with what's happening in the banking world has a lot to do with the stock market, because right now, when there's a banking crisis, the banks don't lend. They have a stricter standard to lend money out. So there's something called the velocity of money. Whenever you have money exchanging hands very quickly, that's really good for the economy, because you have a lot of sales, you got a lot of money being lent and things being bought. But whenever that slows down, like what's happening in the banks right now, they're going to slow naturally the money supply because of all these new rules that are going to have to be. There's going to be big lending standards that are going to be stricter, and there's going to be less economic activity. So this all affects the stocks that we're following because there's not going to be as many sales if the banks tighten the amount of money that's allowed to be spent in the market. Oh, that's confusing. Why do we have to go through all this? But it has a lot to do with the multiples that you pay for a stock, the valuation, the premium, that you pay for a stock. So, does that answer your question, Matthew?
Yeah, I think so. That was what I wanted to see. Okay.
Okay, that's interesting. All right, so we're going to have to make, I guess, for next time, whatever the interest rate currently is, what premium that normally is paid for stocks, and then I guess we can calculate what a stock should be trading at a certain time. We'll do that as an exercise another day, but it's becoming evident that this is really important, when we're investing, just to understand this and how it affects, what people pay for stocks. So the Fed is adding. This is weird because the Fed was reducing the balance sheet by $100 billion a month. Now they just emergency added $300 billion. So that's like QE. That is like the opposite of what they were doing. So that's usually good for stocks. Usually, the stock market's going down now, but okay. So all right. So then
that new adding is for rescuing the banks in trouble, or for buying back something. But
I didn't really read into that. What was for. I assumed it was for providing liquidity for the banks for this whole banking mess. I mean, that's the only thing really they would have had to extend. I think there's something called a window. They extended this $300 billion as a window where banks could trade in some of their worst assets for liquidity. Something like if they have long bonds that are, let's say the unrealized losses for long bonds, there's a certain window that they could trade that in for money, liquidity. So I haven't really looked into that, but this is like a big shift. It's that pivot that people have been talking about. I think pivot meaning they're becoming more accommodative now, and usually that's whenever that happened in the financial crisis, when the Fed says we'll provide whatever you want to get out of this COVID problem, get our small businesses back, get everything back. And whenever that happened, the stock market took off. And right now, the biggest issue is we don't know the next domino that's going to fall in the stock market, in the banks, and how that's going to affect, the rest of the stocks in the stock market. So that's still happening. Today, we still have banks going down 30%. So it's scary. I mean, for those invested in regional bank stocks, but it seems like the quality stocks that we're following are hanging in there because when you have a sell-off, we'll look at a sell-off graph because it's pretty important to look at that. Because this does happen. I mean, right now, this one guy, Game of Trades, he's saying 2008 version 2 is here. There's people on Twitter that are always trying to compare, the current time to, the worst times in history. And they say we're basically at this spot, we had this downward trend, and then you have this 20% drop. And you got to be ready for that if you're a long-term investor, and it could happen whenever you have a loss of confidence, and you have, a sense where people are scared afraid. They're scared. They there's the natural selling, just like there's a bank runs. If you lose confidence in your bank, you take your money out. And the same thing with the stock market. And what happens whenever you have these stock market corrections, maybe 10 or 20%, is you have people. You have a good portion of the market shorting stocks, and then you have people just selling because they're afraid, and that comes to like this crescendo. And then what happens right there is people start buying the quality stocks, the stocks that are, they're still making money, they're not affected by this, and their price, has gone down substantially, and they're good deals. And then you have this 20% return to where it was before that crash. And that happens in usually 3 months. But almost every crash we've had in the stock market, you have a pretty quick recovery. But I'm not saying we're going to do that, but your mindset has to be ready for something like that to happen. And you have to look through everything that you own and say, is this affecting the 5-10 year projections for earnings for the company I'm watching? So we don't know. We don't know if there's going to be a crash. This has all the elements right now of a potential reason for a crash. You have the Fed raising interest rates. If they say next Wednesday, we're going to keep raising interest rates until inflation is done, and then you have it'll go down, and if they say we're going to be accommodative, it'll not go down as much. But this has everything, all the ingredients for lack of confidence by the stock market to make a correction. So, and that's it has a lot to do with these unrealized losses for banks, and if you're forced to sell those unrealized losses to cover people taking money out of your bank, then the crash for a bank is going to happen every time. All right, so let's look at. Okay, we go back to this. Okay, oil is down to $67 a barrel. When it was like 100 and something, we were talking about there were people predicting a recession, and we said at that time, during a recession, oil usually goes down to $60 a barrel because there's a lack of demand. So, and here we are down to 67, which is kind of low. We have a lot of smart people now, like Warren Buffett is buying Occidental Petroleum recently. A lot of smart people saying that, whenever oil is down, this is $60 and $50 barrel prices for oil are pretty low. And that's the time that you want to buy oil stocks, not when it's up at $100 a barrel. So it's getting down there, and that's kind of saying that the global economy is slowing. There's a recession coming. And that's what that's saying. So we have to look at the stocks we're owning and say, well, oil is telling us that there's going to be a recession, or the stocks we're following recession proof, or are they going to do okay? And inflation, we had that report today on Tuesday and Wednesday, and they basically said the inflation's around 6%. So we're going down. It was 6.5%. It's still getting better every month, so that's good. We're in progressing pretty good. But the key thing is this week we had this financial crisis, and that's going to help inflation. So, well, actually, it could help, where the economy doesn't, people are afraid to spend money, and banks don't lend as much. But at the same time, we have the Fed putting $300 billion into the market, which is inflationary. Why do we have to figure this out? Why can't we just look at stocks? I don't know. All right, U.S. dollar index, it's not changing. All right, so let's see. Yeah, let's look at the sectors.
That's why I was asking about where that 300 millions or billions go to, because I don't think it go into the market actually to create liquidities. It's more of a shooting.
Okay, let's look at an article on that right now. I'm gonna try to search for a quick article. Okay, here's the answer. Google will tell us. Banks sought record Fed liquidity in wake of okay. So this is the article. Banks sought record amounts of emergency liquidity over recent days in the wake of the failure. Banks took in $152 billion from the traditional lender of last resort facility known as the discount window, while also taking more loans from the bank term lending program. Yeah, I don't really understand that very well. Okay, so the Fed's bank lending facility was launched on Sunday amid highly unsettled markets. Okay, so basically the Fed basically said that they can loan money to banks for emergency situation. And I think that's all I can say about the 300 billion right now. There's Fed lending money through this window, and I guess banks like I know more Wells Fargo, they took some money from this window. So I guess it's more of like in the TARP program in 2008, they basically gave money to every bank regardless if they needed it or not. Now you have to say as a bank, oh, I got some things I want to exchange for some money. And it's basically these banks admitting to the world that they have some unrealized losses that they have to take care of so that they have money to cover, bank run or whatever. So it's good and it's bad, but it's increasing the balance sheet for the Fed, and that's inflationary. Why do we have to figure that out? I don't know. So if we look at these, the sectors now, let me see, hold on. Sectors that are doing the worst. Regional banking. Wow, it's going down 5.5%. It seems like we're having sell-offs in the banking world again today. This is turning into a crisis, major crisis. Oil is going down because if we go into recession, the price of oil goes down and they don't make as much money, the oil companies. So, and then the things going up the most, gold miner, gold. So let's say when the Fed adds liquidity, that well, I guess gold is a natural inflation hedge. Supposedly, it hasn't been for the past 2 years, but maybe people are gravitating towards gold in uncertain times. And the tech is doing all right, I guess, because why would they be doing good? Maybe because the big tech stocks are have a strong cash position where they don't have to borrow money, and they're a little safer because they have consistency. And some of the more the ones that are holding up today, the sectors, are the ones that are conservative in nature, such as healthcare, the ones that worked really good last year, consumer staples, home construction. Okay, so these that are highlighted are ones that all worked last year because they're basically paying a dividend, they're conservative, and they have steady demand in good times and bad. So we have
about tech, and so I think two things. One is that the if rates stop going up, it's good for the tech companies. I was also wondering like where like Apple has its cash hoard stored, if they have long term or if they have it in like short term items. If rates are actually good for their like huge cash position. I don't know.
You know what's funny is Apple is. I've been following Apple because it's such a big part of my portfolio. They've been borrowing money. When the interest rates were zero, they were issuing bonds and borrowing money. So their cash position isn't as big as it used to. It's like almost a zero cash position. Let's look at the statistics for Apple. See, Apple's doing really good because it's like I guess their earnings aren't going to change a whole lot based on the stuff that's going around these days. But let's look at the cash position. Total cash, like it's only $3 billion. Oh
wow, okay.
That's per share. Total cash is $50 billion. That's still low. Total debt is $100 billion. So they actually have a net debt of $100 billion, not cash position. Because what they did was they bought back stock, and they issued bonds whenever they could when they could borrow for almost zero, maybe 1%. They started borrowing a lot of money and buying back stock, and knowing that they could always generate cash when they want, But so they're actually they don't have. I think they invest in treasuries too. Some very, very secure things, but they don't. They actually have more debt than they have cash right now. They used to have a huge hoard of cash, but they bought back stock with that, and so. But they look at the cash flow they have, so they could easily, be cash positive if they didn't spend money in the quarter, for instance, right?
Okay.
So that's interesting. We don't. I'm not sure. I think the last time I checked, they had their money in short-term treasuries, something very secure. I don't think they would invest in long-term.
One thing about Apple is the cash portion not entirely parked in the U.S. Many of them, a big portion of them, in outside the U.S. and they will not bring it in the U.S. for the tax reason. So even though they invest in the short-term security, it's not a big portion of their cash go into short-term security. It has just a small portion that actually in the U.S.
Oh yeah, right. They have a really unique accounting system where they were using like an Ireland-based company to hold a lot of their profits from overseas, and we'll never understand that really. It's really complicated, but I'm sure it's legal. And what they're doing, whenever there's a window for repatriating money, I remember the last time they did that around 2000, I forget when, but the government had a window of time where you can repatriate as much as money as you want without incurring any taxes. And so Apple imported all that money from their subsidiaries around the world. So then I guess, but it seems like right now they don't have a whole lot of cash. That from what we see in this chart. So I'm sure that they have it in something secure, short term, maybe two month treasuries or something. So I think that's the best I can say for Apple. But yeah, you're right. Whenever the interest rates stop going up, that is good for the tech stocks. That's why we had that huge relief rally this week. Yesterday, it went up 2%. And if there is some kind of end to the interest rates rising, then things basically get back to normal for the stock market and for the tech stocks we've been following. All right, so what else? Let's look at the change. Okay, so we're going to see some banks in this top 10 decliners. Let's look at the top 10 market movers. The ones doing good. Okay, still. I have a little write-up later on today talking about the big tech stocks. In this past week, during the economic crisis of these banks, the big tech stocks are the ones that were holding up the market from crashing, because they were up. They were up 10% in the last week around. And Google was up 10% this week. And I think what's happening, I think one way to explain that is, like Matthew was saying, when there's a sign that the interest rates are stopping to go up, that affects the borrowing costs of all the tech stocks. So you're going to have a rally whenever the Fed next Wednesday, if they say we're going to stop and we're going to support this financial crisis and see what happens, that's going to make, all the big stocks that have been held back by this, this situation, that's going to make them just take off. So for me, I know it's a time this next year where it's going to be sideways, for the tech stocks until we have this interest rate thing back and everything back to normal. But like I was saying last week, whenever you sell a stock, if you sell your big cap stocks, you got to find something better than that. You got to time it right, and you're going to lose 20% in capital gains. So whatever it is that you sell, the next thing you buy has to be 20% better than what you have, because you have to pay capital gains tax on your sale. Look at that. Look at the ones that are down. Bank stocks. Wow. All the regional bank stocks are going down. But First Republic, they got some money from the big banks for liquidity, but oh boy, that's a mess. We'll never understand this. So a lesson learned with this is, if there's a stock, we know the business models of the stocks we're following. For these banks, we don't know. We don't understand banks. There's no way, even the banking analysts don't understand them. So I think we got to stay away from things that are not our key competence. And you can't play a hero and try to buy some of these now. It's just nuts. I mean, they can go out of business easy. But almost every one of the banks has unrealized losses, because when you're a bank, you loan money to people for higher interest rates, and you kind of make money. You have depositors that put their money in the bank, and you actually, whenever they deposit money, you invest that in long-term securities that are generating money. And that's the business model. Is then they lend money out to people using that deposited money from other people. Wow, this banking thing, some days we'll understand it, but right now it's a good idea to stay away from this.
So banking have two different sectors. Right? One is retail banking, which is future described. The other one is investment banking, which is taking much more risk. Investment banking is the one that we are very complex. Retail banking are very simple in the business model.
Yeah.
And then the bank that failed, the Silicon Valley, is the regional retail, investment banking, and therefore it takes a lot more risk.
Yeah, I guess the problem with Silicon Valley Bank, they had a large number of they had 50 billion. They had companies with 50 billion, 100 billion, in deposits, and it's so easy to take that out. It's so easy for the 200 biggest companies to withdraw it all overnight. And whereas you have a company like Charles Schwab, They're brokerage. They have millions of customers. They're the biggest brokerage in the world, but they're still going down with this crisis. Even though it's going to be harder for it, they have a stickier deposit base. I mean, I'm not going to switch my brokerage, very easily. But it's easy to withdraw $50 billion if you're worried your company's going to go bankrupt if the bank goes bankrupt. So you have a stickier user base than some of these other companies that prevent that run. But what hey Mark, what do you know about M-Phase Energy? This is one that's Mark's been following. It's down 8% today. Why do you think that's happening?
Good question. They seem to be very volatile. Some days they shoot up, some days they go down. Just holding it.
Yeah, you're right.
But my solar panels are doing great today. Much better than yesterday.
Oh, I wonder if that has anything to do with the price of the stock.
No, just the sun.
Well, all the energy stocks are going down. We have solar related stocks going down. So maybe there was one of those stocks that made a bad report. Okay, so we do have a crisis in the banking. I don't think that's going to go away anytime soon. And what's happening are people gravitating towards larger companies that have steady growth, that are not affected by a banking crisis. The companies that have cash, well, we know Apple doesn't have cash, but Google has a lot of cash on hand. Microsoft, they have a lot of cash. So I think that's what we can learn from that. Let's look at the next one here. I think it's Matthew's idea that as interest rates have peaked, maybe, and the Fed might be saying that they're not going to raise interest rates anymore. That could help all the tech stocks. And the ones that are doing the worst, higher PE stocks. All right, so let's look at the Dow. All right. Yeah, we can see the banks and...
Coca-Cola went down a lot.
Which one? Coca-Cola?
Up on yeah.
Okay, it's not down that much. I would think that consumer staples is one of the safest places to be, because we know Pepsi. We've been following Pepsi for a while, and they've been raising their prices, and they have a consistent demand. If your stock portfolios go down, you get a layoff. You're gonna still drink your Pepsi, regardless of price, and you're still gonna eat your Frito-Lays. So it's the same thing with Coke. You have a steady demand, and they pay a dividend, and it's kind of a safe thing in this environment. Yeah. So we have Procter and Gamble, same thing.
So on the Coke side, my understanding is that Pepsi raised prices first, Coke followed, and that they saw a pretty minimal drop in sales. And so they felt like they could keep their higher prices. I've actually been buying less Coke because I've been buying more Dr. Pepper products because the Coke's just been 50% more expensive. They just aren't having the sales. Yeah, it's costing like $7 for 12 cans at the store, and they don't have very many sales. And I can get the Dr. Pepper products for like 2/3 of that right now.
Wow, I didn't realize that.
Yes, they definitely raised prices. They've talked about it on their earnings call, and it's a well-known thing that they took this as a measure, and they didn't lose sales, so they're going to keep it, I think.
Right. All right. So I think that we've been saying probably for close to a year now, the companies that'll be steady in this environment are the ones that can raise the prices and that have a steady demand in good times and bad. And so I think that's the theme for all these stocks in the Dow that are going up. And the ones that are going down the most, Goldman Sachs, Mark, we have all these investment banking, Goldman Sachs. We have 3M. We'll talk a little bit more about that later on. 3M is the company that's has a lawsuit. They have probably an unlimited amount of liability from hearing loss of military members from using their earplugs. And we're going to look at how J&J, Johnson & Johnson, they have a similar unlimited liability, and they're starting to follow the pattern of, here it is right here. J&J, look at this. We were saying, how Johnson & Johnson, as soon as they've been going in like a sideways pattern for a while, but as soon as they said you can't use that, they had a vehicle to try to limit their liabilities in the talcum powder lawsuit. It's starting to follow this pattern of 3M, where you have unlimited liabilities. This is a 2-year chart of 3M, and they're still going down today. So you can see whenever you have this thing, unlimited liabilities for this, we don't know what the end of that lawsuit's going to happen, when it's going to happen, how much it's going to be. Stocks basically trade down, and you got to be, you got to realize that could, even though the stock, performs well with all of its metrics, and when you have something hanging over a stock that's an unlimited liability, the stock, people don't pay premium for it. And J&J right now, we've been following it, but it's still selling at a premium, and that'll go down until that's resolved. So so we continue to sell on MMM, which is 3M. All right. So our big picture here is we're in March. We're having a sell-off in the market. None of our stochastics work in this environment. Everything's pretty sold off. If we look at the S&P, we mentioned right here, we had a breadth of the market. Walter Deemer told us, this is pretty important. There's only a certain amount of strength. I mean, this is a very powerful move from here to here, and we have breadth in the market, and it's carrying in this upward momentum where we have higher highs, higher lows. And this right here is what people on Twitter call the line. This is the downward trending line that we're still trying, we're tracking that. We're right at the bottom of this. We're making higher highs, higher lows. But this banking crisis, if the last week at this time we said this whole situation could evolve into a crash, like a 2008 crash. The Fed, whenever they jumped in and helped Silicon Valley Bank and insured the depositors, that partially stemmed the crisis. It stopped the crash from happening. But as you can see today, we still have banks going down 20%. And if you have that loss of confidence, we could easily go down, resume this downtrend, and go down to here next, or worse. And we could go down to that, you see, where are we here? Okay, yeah, so we could, hold on for a second, let me get there. Oh, yeah. We could do this thing too. But in the end, but as a long-term investor, I see this as it's like a blip. You have to, if you're a long-term holder, even if you sold here and you knew it was going to go down, you still have to buy something at the right time, the perfect time, that's 20% better than what you're holding now. And we're monitoring most of the stocks, regularly, so we have to make sure that, we don't know what's going to happen, in a crash situation. But whenever this does happen, we got to look at the fair values, making sure that nothing we're following is affected by these things. But we don't know. All right, let's go back to some more talking points here. I got a couple more interesting things to say. Okay, so Dan Niles, we're following him. because he's a super savvy long short hedge fund investor. He said 3,000 is like a fair value for the S&P. So we're keeping our eye on that. We're still way above that now, but Dan Niles thinks that we do have a chance of staying sideways, 50% chance of staying sideways for the rest of the year, or going down maybe to 3,000. We're getting more fearful every week. I mean, having bank stocks go down 20% doesn't instill greed. So, and the VIX are not unchanged since last week. It's 23. So it's still, it's not at a 30. There are people that actually look at this fear indicator, the VIX, and when it gets to 30, they buy, and when it gets down to 20, they sell the stock market or stocks. So right now we're pretty much in between. Now let's look at, we already said that. So if the government didn't save Silicon Valley Bank, there'd be runs on every regional bank until all the regional banks were bought out by the big banks, and there'd be three banks left. That's basically what would have happened if the Fed didn't say anything or do anything on Sunday. So, yeah, I don't know what's going to happen there, but this is our first crash we've had, doing this. So we already talked about this. So it looks like the Fed, this whole banking crisis has done the work of the Fed. So that means the Fed doesn't really have to raise interest rates to slow the economy. This whole crisis is affecting the banks and how they lend money, and so it's getting back to normal. We might have a 20% correction before we stop all this, but I did a stock screen. we've been seeing Charles Schwab on our screens for weeks now. It's been growing at 20% according to Fidelity, and it's basically went down a lot in the last week. So that's why we do these stock screens. And I remember 2 weeks ago we were saying it's super pricey. It was growing at 20%, but its PEG ratio was 2. And I said, let's wait for it to crash before we look at it. So now it's actually correcting, and it's down a lot. And we're going to look at it just for kicks to see where it's at right now. Okay, so we're following Dan Niles on Twitter. He's like super transparent with what he's doing, and he talks on CNBC a lot. But right now he was trimming Meta. He wants to buy him back. He says the spending cuts that they announced were good, and TikTok could be banned in America if they don't sell it. So that's really good for Meta. He likes oil now, like we were saying about whenever people are selling oil and the oil prices are down, the smart people are buying and starting to buy baskets of oil names. So he mentions that the Strategic Petroleum Reserve needs to buy oil, and they said they'd buy oil below $70 a barrel, which is where it's at now. So you have the demand from the Strategic Petroleum Reserve, and you have China buying oil, and that could be catalysts for the price of oil to go up. And the other things he says he was on the CNBC, and they said, "What financials do you like now?" And he said, "Schwab, which I bought near the close, is a brokerage, not a bank, because it's since a week ago, 2 weeks, 10 days ago, it's down 24% versus the banks, regional bank, which is 22% down, and then the XLF, which is the financial, is only down 8%. So he thinks it's a good stock. So, and it's maybe being thrown out by the bathwater. So we're going to look at that because then now it's on our screen. We've been watching that. It's been overpriced. We're going to look at it and see if it has any value here. So I looked at the earnings estimates for the next couple of years, and it seems to be pretty inconsistent. 6%, 20, 17, -5, and Bank of America thinks it's growing at 11%. So I gave it it's growing around 16% if you add all these up, and its PE ratio is 16, so it's basically fairly valued now. And I think this is an example of throwing the baby out with the bathwater. But the biggest problem, the biggest wart for this company right now, the reason why it's going down, is they bought a lot of long-term treasuries, and their unrealized losses, they have large unrealized losses. So if they were forced to sell that, they'd have to take a big hit and a loss. And that could cause problems for them. But Dan Lau says that the difference is that they have deposit inflows, and there's people that aren't going to be closing their brokerage because of this. But if that happens, then there's going to be a big run on Charles Schwab, and it could go out of business. So that's, I mean, it's interesting to do this. You know, we were following it when it was a PEG ratio of 2, and we said it was overvalued. But right now, this is like crisis mode for this company, and they've traded down to PEG ratio 1, and they're still going down today, another 5%.
Charles
yes.
Schwab, all TD Ameritrade, so if bank run on Charles Schwab, we screw.
Oh, could you repeat that one more time?
Charles Schwab,
yes.
all TD Ameritrade. So
yeah,
if Charles Schwab had a bank run, we're going to be in big issues.
I don't know. Everyone's, say if there was a run and my brokerage that I have, you know, went out of business, they're not going to take your stocks because those are yours, regardless of where it's held. It's going to be transferred somewhere else. You know, if Charles Schwab goes out of business, it's just going to be, that could be, you know what, if there was more problems with Charles Schwab and people started selling everything in their accounts, that could lead to a crisis. You know, because it's the largest brokerage in America. And if there was a loss of confidence, there's nothing to protect against a bank run or a run where you take all the liquidity out of a company, you know? So if every investor decided to move their money from Charles Schwab to another one, E-Trade, they'd have to go out of business because they have all these unrealized losses because whenever people put their money in, they have a lot of cash that's not invested in stocks. So they can reinvest that into treasuries or whatever they want to, but they made the mistake of putting money in long-term treasuries. I don't know. It's this we were following it because it was a consistent business model, but whenever you have an intangible, like a possible bank run on a company, you can't touch this. You know, even though we're doing the exercise to understand it's a fairly valued stock now, it's still, just like J&J, it's untouchable for us because we don't know. There's a possibility that there's a bank run, there's a loss of confidence, and they have to realize these unrealized losses, and then it goes bankrupt. So it's just something that, you know, we don't understand this well enough to figure this out, and there are stocks that are easier to understand that we can invest in. But whenever you have a potential of going out of business, like J&J or 3M or, you know, any of these banks, JP Morgan's not going to go out of business because they have a lot of rules they're following. They have a lot of cash. You know, they actually take advantage of situations like this, you know, and they get bigger. But we don't know we don't know enough about banks to make these decisions. But we're just doing this because it presented itself to us. All right, let me see. Let's look at I got a couple more things to go before we're see. Okay, I told you about this. Bank of America has unrealized losses. 113 billion of unrealized losses. They might go to that discount window and try to trade some of these losses for cash right now, and that's another 113 billion the Fed's giving, and that's inflationary. Let's look at okay, since last week.
Sorry, 2000 last year stress test on Bank of America showed that Bank of America had $170 billion reserve.
Oh, what's okay in reserve?
Yeah, stress test 2012.
Oh, well,
22.
22. Hey, well, maybe this guy on the internet and Twitter isn't that smart after all. I don't know. So we'll never understand it. We just have to stay away from banks right now. You can't play hero. Since last week, Apple is up 5%, Alphabet 10%, Amazon 10%, Facebook 13%. So people are gravitating towards companies that have predictable cash flows and have a lot of cash. And with the Fed pivoting, that means the return to growth and all the tech stocks will benefit if we have the statement saying that, we're going to stop this and see what happens. So there's another story by Jim Cramer. He says, rock solid balance sheets of big tech like Meta makes them safe investment for a bolt-on market. So that's another reason I've always had confidence in my larger positions in the big tech stocks, because they have cash, they can survive events like the COVID and this banking crisis. They don't need to borrow money, and they have consistent sales. So you see. Okay, well, we don't have time for this. Jim Cramer likes this TJX. They're a discount retail. They sell inventory of other people that they can't get rid of. So I just showed that they're growing at 12%. I did the calculations, and their PE is 25. So their PEG ratio is 2. So they're taking advantage of all the inventory problems that we've been having and seeing in all these stocks. But still, for a stock to have a PEG ratio of 2 in this environment, that's pretty overvalued. I don't know, Jim Cramer. I don't know about this one. We'll keep our eyes on that. But let me see the other things. Okay, we're basically have gone through a despair period, through this banking crisis, and maybe, just maybe, we're going down to a capitulation phase. So we don't know, but you have to keep an eye on 10-year time frames. Is this company going to still do good in 5-10 years? And if so, you have to ignore these capitulations if they happen. And that's just about it. I'm a little bit over time today. Thanks for attending, and have a good weekend, everybody.
Thank you, Craig.
Thank you. Thank you.
Thank you.
All right.
You too.
Thank you, Greg.
See ya.